Hello everyone, this is Nitish and this is Plums series, which is Prelims Level Up MCQ series. Here we discuss 5 MCQs daily and this will help you in your UPSC preparation. Today is episode number 291 and I am dealing with economics MCQ. But before starting this class, I would like you to please subscribe the channel and also like and comment on videos. These contents are free of cost. So for test series and foundation video, you can contact to Vysh or on WhatsApp 7200 681 675. So let's begin. Today's MCQ number 1. Which one of the following does not influence quantity demanded for a good? A. Goods own price. B. Price of a complementary good. Price of a substitute good. And last is price of inputs into production of the goods. So I will give you 10 seconds. Try to answer this question. So its correct answer will be option number D, that is the price of inputs into production of the good does not influence quantity demanded for a good. The amount of the good that consumers are willing to buy at a given price during a specified time period. Holding constant the other factors that influences purchase is the quantity demanded. So it is basically the definition of the quantity demanded. Potential consumers decide how much of the goods or services to buy on the basis of its price. Price of input into production of good does not influence quantity demanded for the good, that is statement number D, and this factor does not influence the quantity demanded for a good. Now move on to MCQ number 2. Consider the following statements. When an economy goes through a phase of high inflation, there are chances that the unemployment rate will fall. High inflation will increase the purchasing power of the consumer. The RBI monetary policy has a direct impact on controlling cost push inflation. So how many of the above statements are correct? Only one, only two, all three, none. I will give you 10 seconds. Try to answer this question. Those who want more time, they can pause the video and answer. And its correct answer will be option number A, that is only one statement is correct. Statement 2 and statement 3 are the incorrect one. Now let's look at the explanation. There is a trade-off between inflation and unemployment. Typically, when the economy goes through a phase of high inflation, chances are that the unemployment rate will fall. That's because firms intensed by the higher prices try to ramp up production by recruiting more people. High inflation may be robbing people of their purchasing power. It is also important to understand that monetary policy does not have a direct solution to control cost push inflation, which is statement number D, that is the RBI monetary policy has direct impact on controlling cost push inflation. But in the explanation, we can see that it has no direct impact or does not have a direct solution. It cannot make fuel price lower by raising interest rate. All it can do is to control demand in the economy. So it is basically the explanation of the statement number 2 and statement number 3. Here in statement number 2 it is written that high inflation will increase the purchasing power of the consumer, but it is false because it decreases the purchasing power of the consumer. And if you want to make notes, then you can follow my solution. MCQ number 3. Consider the following statements regarding prepaid payment instrument, and it is taken from the current affairs. Prepaid payment instruments are the payment instruments that facilitate the buying of goods and services, including transfer of funds and remittances, against the value stored within the instruments. PPI are in the form of smart cards, mobile wallets, and magnetic chips. As per the regulations, NBFCs, that is non-banking financial companies, cannot issue PPI, that is prepaid payment instrument. So you have to identify how many of the above statements are correct. Only one, only two, all three, none. I will give you 10 seconds. Try to answer this question. So its correct answer will be option number B, that is only two statements are correct. Statement 3 is the incorrect statement, which means NBFC can issue PPI. Now let's look at the explanation. The RBI defines prepaid payment instruments as payment instruments that facilitates the buying of goods and services, including transfer of funds, financial services, and remittances, against the value stored within or on the instrument. The PPI are in the form of payment wallets, smart card, mobile wallets, magnetic chip, which is statement number 2, vouchers, etc. As per the regulation, banks and NBFC can issue PPI. That's why the statement number 3 is the incorrect one and rest other two statements are the correct. MCQ number 4. In economics, the Angel's law indicates the relationship between tax rate and the amount of tax revenue collected by the government, that inflation and unemployment have a stable and inverse relationship. As income rises, the proportion of income spent on food falls. Distribution of income or wealth within a population. So I will give you 10 seconds. Try to answer this question. So its correct answer will be option number C, that is Angel's law indicate as income rises, the population of income spent on food falls. Here it is also written the same, that Angel's law suggests that as income rises, the proportion of income spent on food falls even if the absolute expenditure on the food rises, which is statement number C. Last MCQ of today's class, consider the following statement regarding credit line. A credit line is a a credit line is a preset borrowing limit that allows an individual or business access to credit at any time as per need. Statement 2. It is like a flexible loan as against a lump sum loan where a fixed amount is borrowed. So you have to identify the correct statement regarding credit line. One only, two only, both one and two, neither one nor two. So I will give you 10 seconds. Try to answer this question. Its correct answer will be option number C, that is both 1 and 2. A credit line is a preset borrowing limit that allows an individual or a business access to credit at any time as per the need, which is statement number 1. It can be tapped into it can be tapped into by the customer till the limit offered is not exceeded. It is a flexible loan as against a lump sum loan where a fixed amount is borrowed, which is statement number 2. So on the basis of the solution or on the basis of the statement, you can make a notes and both the statements are true regarding the credit line. So that's all for today's class. Hope you like the content and video. Next episode will be tomorrow. So please subscribe and stay tuned.